People often think the secret to wealth is about finding that one big idea, that magical stock, or that perfect investment strategy that beats the market. But in reality, the secret lies in something much simpler and far less glamorous: avoiding stupidity. The biggest advantage you can give yourself, especially if you're over 50, is not in trying to be brilliant, but in refusing to be foolish. Most people fail financially not because they didn't find the next Apple or Tesla, but because they made basic, preventable mistakes: overconfidence, greed, impatience, and ignoring what they don't understand. If you can simply remove stupidity from your process, what remains is intelligence by default. At this stage in life, your financial goal should not be about swinging for the fences. It's about keeping what you've built, growing it safely, and making sure time and compounding do their quiet work. You can't afford to recover from reckless risks anymore. The young can afford to lose big because they have time to rebuild. But when you're past 50, every bad decision compounds negatively. That's why avoiding stupidity becomes far more powerful than chasing genius. Think of investing like a marathon. You've already run most of the race. Now the goal is not to trip over your own feet before the finish line. Avoiding stupidity starts with humility. You have to accept that you don't know everything, and you never will. The world is full of people who look smart for a while because they're loud and confident, but in the end, results are all that matter. Smart people get crushed in the market every day because they mistake intelligence for infallibility. The truth is, arrogance kills more portfolios than ignorance ever will. So the moment you think you can't be wrong, you're already in danger. The first rule, therefore, is to respect the limits of your own knowledge. Stay within what you understand deeply. Another form of stupidity is chasing trends. People love excitement. They love the idea that they're early to something revolutionary. Whether it's cryptocurrencies, speculative tech stocks, or get-rich-quick schemes, there's always a crowd running in one direction. The wise investor watches them go and smiles quietly. You don't need to join every parade. Most of these speculative manias end the same way. They collapse, and people lose their shirts. When you avoid that circus, you're already ahead of most participants. Remember, it's far easier to stay rich than to get rich twice. Then comes the stupidity of overtrading, constantly buying and selling, reacting to every news headline. Trying to time the market, it's a fool's game. Every time you act out of emotion instead of reason, you transfer a little piece of your wealth to someone more patient. The best investors are not hyperactive. They're like snipers, calm, deliberate, waiting for the perfect shot. They understand that inactivity is often the most intelligent form of activity in investing. Don't confuse motion with progress. Another subtle form of stupidity is ignoring risk. People often look at their returns, but rarely at their exposure. They'll say, "I made 20% last year," without realizing they were one event away from disaster. True wisdom in investing comes from focusing not on how much you can make, but on how much you can afford to lose. If your portfolio can't survive a 50% drop without you panicking, you're overexposed. At 50 and beyond, you must build resilience, not just returns. And finally, there's the stupidity of listening to the wrong people. The financial world is full of noise. Advisors, influencers, commentators, all eager to sound smarter than the next person. But the truth is, very few of them have any skin in the game. The best filter you can develop is skepticism. Don't believe every hot tip, every forecast, every guaranteed strategy. Ask simple questions. How do they know? What's their track record? Are they selling something? Avoiding the wrong voices is just as important as following the right ones. When you eliminate stupidity from your decision-making, what remains is clear, rational judgment. You don't need to be a genius to do well. You just need to avoid doing dumb things. Over time, that alone will compound into extraordinary results. So if you're over 50, remember this simple principle. You don't need to be clever. You just need to be consistently not stupid. That single rule will protect your capital, preserve your peace of mind, and give you the financial independence you deserve. Staying within your circle of competence is one of the most underrated yet powerful principles in investing, especially once you're over 50. At this stage, your financial journey is no longer about chasing excitement. It's about making decisions that are smart, steady, and based on real understanding. The truth is simple. You don't have to know everything, but you must be brutally honest about what you do know. The world rewards specialization. Knowing your limits and respecting them can save you from costly mistakes that ruin decades of discipline, saving, and hard work. A circle of competence means understanding the boundaries of your knowledge, where you truly know what you're doing and where you're just guessing. Most people never admit the difference. They think reading a few headlines or watching a few videos makes them experts in a complex field like technology or crypto or real estate. But when real risk hits, that false confidence collapses. When you're investing with your retirement savings, there's no room for guessing. A single bad decision made outside your area of understanding can wipe out years of progress. Think of your financial life like a map. Inside the circle are the businesses, industries, and assets you fully understand, where you know how they make money, what drives their success, and what risks they face. Outside that circle lies everything else, tempting opportunities, popular trends, things that sound smart but are in truth built on hope and hype. Your job is not to make the circle huge. Your job is to know exactly where the edge is and never cross it blindly. The older and wiser you get, the more you realize that discipline, not diversification for the sake of it, is what keeps you safe. One of the biggest traps for investors over 50 is the illusion of knowledge. You've lived long enough to see many cycles, booms and busts, bubbles and crashes, and that experience gives you confidence. But experience doesn't automatically make you competent in new areas. The world changes fast, technology evolves, economies shift, and new industries rise and fall faster than ever. Staying within your circle doesn't mean refusing to learn. It means refusing to gamble. You can study new areas gradually, expanding your circle over time, but don't bet heavily until that knowledge is deep, tested, and proven. When you stick to what you know, your decisions become calmer and more rational. You stop reacting emotionally to headlines and market noise. You understand why your investments move the way they do. You can evaluate risk based on facts, not feelings. This clarity is priceless, especially when time is no longer your strongest asset. People over 50 don't need volatility, they need predictability. Knowing your circle of competence gives you exactly that, a sense of control in a world that constantly tempts you with chaos. Another advantage of staying within your circle is that it helps you resist envy. Envy is one of the most destructive forces in investing. You'll always see someone making money faster, bragging about new ventures, or showing off impossible returns. But most of those stories end badly. By staying within your circle, you build peace of mind because you know your own plan, your own strengths, and your own pace. You don't chase other people's success, you defend your own. Think about it this way. If you've spent your career understanding certain industries, say manufacturing, banking, or healthcare, those areas are where you hold a real advantage. You know how the business works, what a strong balance sheet looks like, how customers behave, and what red flags to avoid. That's your competitive edge. Someone else might make quick money in a sector you've never touched, but that's not your game. If you stay disciplined and play within your strengths, you'll outperform the majority who jump from one fad to another. This approach also protects you from emotional errors. When markets fall, people who invest outside their circle panic because they don't truly understand what they own. They sell low, regret it later, and lose twice, in money and in confidence. But when you know your investments deeply, downturns don't scare you as much. You understand that value and price are not the same. You can hold through the storm because you have conviction grounded in knowledge, not hope. Ultimately, knowing your circle of competence is not about limitation. It's about precision. It's about focusing your capital and your energy where you have the highest odds of success and the lowest odds of stupidity. It's about using your lifetime of experience to make better, not broader choices. At 50 and beyond, that's how you protect your wealth and ensure your money keeps working for you. Quietly, efficiently, and intelligently. Preparing for large drawdowns is one of the most vital habits an investor can build, especially after 50. By this age, you've seen enough market cycles to know that no bull market lasts forever. And every long period of optimism is eventually followed by sharp corrections. The markets have a way of humbling everyone, no matter how confident or experienced they think they are. The key to surviving and even thriving through these times isn't prediction, it's preparation. You don't have to know when a crash will happen, but you must be ready for when it does, because it always does. Drawdowns are not an if, they are a when. Over the course of your investing life, you will face several. Sometimes they last weeks, sometimes years. Stocks can fall 30 cents, 40%, even 50% or more. Real estate can freeze. Interest rates can rise unexpectedly. Currencies can fluctuate, and fear spreads faster than reason. When you're young, you can afford to take bigger hits because you have decades to recover and reinvest. But after 50, recovery time matters. You cannot rebuild from large losses as easily as before. That's why preparation becomes more important than prediction. Preparation starts with mindset. You have to expect pain. Markets are designed to test your patience and your conviction. Every investor faces moments where it feels like the world is ending. The best survive those moments not because they're fearless, but because they plan for them in advance. They accept that temporary losses are part of long-term investing. They know volatility is not a bug. It's the price of admission for the rewards of compounding. When you treat volatility as normal, you stop making desperate decisions when it arrives. Then comes structure. A resilient portfolio is built before the storm, not during it. Diversify intelligently, not by owning 100 random stocks, but by spreading risk across different asset types that respond differently to shocks. For instance, a mix of equities, bonds, and cash gives you flexibility. If one part of your portfolio falls, another part cushions the impact. It's also wise to keep a portion of your wealth in safer, liquid assets, something you can access without selling investments at the worst possible time. Liquidity is not just comfort, it's power. It gives you options when others are panicking. The next step is psychological preparation. Many investors overestimate their risk tolerance. It's easy to say, I can handle a 40% drop when markets are calm. But when you see your lifetime savings shrink on paper, your instincts change, fear takes over. You start to justify selling at the bottom or abandoning your plan altogether. That's why it's crucial to test your tolerance before the crisis. Run scenarios. Ask yourself, if my portfolio fell by half, what would I do? If your honest answer is panic, then you need a more conservative mix. It's far better to accept lower returns than to make catastrophic emotional decisions later. Another aspect of preparation is avoiding leverage and unnecessary complexity. Borrowing to invest can magnify returns in good times, but it also magnifies pain in downturns. Leverage doesn't just multiply risk, it shortens your survival time. The market can stay irrational longer than you can stay solvent. Similarly, overly complicated strategies that depend on perfect timing or mathematical precision often collapse under stress. Simplicity is underrated because it's boring. But in turbulent markets, simplicity is what saves you. Finally, the best preparation for drawdowns is to maintain perspective. Every crash feels unique while it's happening, but history shows a clear pattern. Markets fall, people panic, the strong stay invested, and eventually, prices recover and rise higher. This has been true for centuries. If you build your financial life around that truth, you'll stop fearing downturns and start viewing them as opportunities. Cash saved during good times becomes your weapon during bad times, allowing you to buy assets when everyone else is selling. Preparing for large drawdowns is not about pessimism, it's about realism. It's about understanding that risk and reward are two sides of the same coin, and that protecting your downside is what keeps you in the game long enough to enjoy the upside. At 50 and beyond, your strategy should be designed not to impress anyone, but to endure. You can't control when the next storm hits. Avoiding stupidity is one of the most valuable skills an investor can ever learn, and it becomes absolutely essential once you reach the stage in life where rebuilding after mistakes is no longer easy. People think success in investing is about genius, spotting the next big thing, timing the market perfectly, or outsmarting everyone else, but in truth, it's usually about avoiding self-destruction. Most financial disasters don't come from ignorance, they come from overconfidence. If you can learn to sidestep stupidity, you don't need brilliance. Because over time, avoiding dumb mistakes compounds into extraordinary results. As you grow older, your financial focus naturally shifts. In your 20s and 30s, you can take risks, experiment, and learn by trial and error. But when you're over 50, you've already built something worth protecting. The goal now isn't to double your money overnight. It's to make sure your wealth lasts and works for you. The beauty of avoiding stupidity is that it's entirely within your control. You can't control market returns or interest rates, but you can control your behavior, your patience, and your judgment. Most people lose money not because the market betrayed them, but because they betrayed themselves. Avoiding stupidity begins with understanding human nature. People are emotional creatures. They chase greed when markets rise and run from fear when they fall. They think short-term when they should think long-term, and they mistake volatility for risk. The first step in becoming a rational investor is to accept that emotions are your biggest enemy. Once you recognize that impulse-driven decisions are the main cause of financial pain, you can start building systems to protect yourself from your own weaknesses. Another form of stupidity is chasing what you don't understand. The world is full of new investment ideas, cryptocurrencies, startups, complex financial products, speculative funds. They all sound exciting, and each comes wrapped in the promise of easy wealth. But excitement and safety rarely live in the same house. If you can't clearly explain how an investment makes money, who controls it, and what could make it fail, you have no business putting your savings into it. At 50 and beyond, the margin for error shrinks dramatically. You're not playing for adventure anymore, you're playing for security and freedom. Then there's the stupidity of impatience. Compounding is the most powerful force in finance, but it requires time and stillness. Many investors sabotage themselves by constantly reacting, buying high, selling low, and confusing activity with progress. They think they have to do something all the time, but in reality, doing less often means earning more. A patient investor lets good assets work quietly in the background. You don't have to chase every trend, you just have to avoid interrupting your own compounding. Remember, the market is a device that transfers wealth from the impatient to the patient. Avoiding stupidity also means managing risk before it manages you. People often say, I can handle risk, but most only realize their true tolerance after they've lost money. A smart investor plans for volatility before it happens. You can't predict when markets will drop, but you can prepare for the fact that they will. Having cash reserves, maintaining diversification, and avoiding leverage are not exciting, but they're the habits that keep you alive when others drown. The key is survival. You can't benefit from future opportunities if you don't stay in the game. Perhaps the most common stupidity is listening to noise. The financial world is full of experts who speak confidently but often have no accountability. They predict recessions, booms, and crashes, most of them wrong more often than right. The antidote to that noise is clarity. Have your own framework, your own reasoning, and your own discipline. When you know why you own what you own, the opinions of others lose their power over you. Wisdom in investing comes from independence, not imitation. In the end, avoiding stupidity is less about brilliance and more about restraint. It's about saying no to what you don't understand, resisting greed, ignoring panic, and refusing to gamble your security for short-term excitement. Over time, the investor who avoids major mistakes will outperform the one who keeps chasing clever ideas. At 50 and beyond, your best strategy isn't to become a genius, it's to stay sane. Avoid the big errors, protect your capital, stay calm through storms, and let time quietly reward your discipline. That's not flashy, but it's the kind of intelligence that actually lasts.